Washington, nearly a decade after the Federal Reserve embarked on an unprecedented effort to shore up the collapsing American economy, the central bank said on Wednesday that it would begin withdrawing some of the trillions of dollars it invested in the wake of the 2008 financial crisis. The decision, while widely expected, is nevertheless a significant sign that the Fed is confident that economic growth and low unemployment will continue. In other words, the central bank believes that the American economy has emerged safely from the crisis. The basic message here is U.S. economic performance has been good, Janet L. Yellen, the Fed's chairwoman, said at a news conference following a two-day meeting of the Fed's Policy Committee. The Fed's retreat from its post-crisis stimulus campaign will be slow but steady as the central bank looks to shrink the enormous $4 trillion portfolio it amassed through a bond buying spree. Those efforts, known as quantitative easing, plunged the Fed into uncharted waters as it tried to navigate the worst financial crisis since the Great Depression. The Fed came under stiff criticism for the program, prompting many Republican lawmakers to question whether the Fed should remain independent. Continue reading the main story-related coverage as economy grows. Fed set to shrink bond holdings. Sept. 19, 2017. Stanley Fischer, Fed's number 2 official, is stepping down. Sept. 6, 2017. The Fed, which stopped its buying spree in 2014, is now preparing to pare back its holdings by about $10 billion per month initially. That is likely to raise borrowing costs for consumers and businesses, but only very slowly. Indeed, since the Fed ended its bond buying, countervailing factors have actually reduced some borrowing costs, like the average interest rate on 30-year mortgages. Investors are watching warily, but so far there is little sign that the Fed's retreat is tightening financial conditions. Stock prices fell modestly after the Fed's 2 p.m. policy announcement, but bounced back by the end of the trading day. The S&P 500 index rose 1.59 points, closing at 2,508.24. The yield on the benchmark 10-year Treasury also rose 0.02 percentage points, closing at 2.27%. The Fed did an extremely good job of preparing us for commencing the balance sheet rundown, said Peter Hooper, chief economist at Deutsche Bank. That's happening with a whimper, but handled differently, it could have been a big event. The Fed, which has raised its benchmark interest rate twice this year, left that rate unchanged Wednesday, but indicated that it plans a third rate increase later this year as economic conditions continue to strengthen. The Fed said it expects the labor market to continue strengthening and the economy to expand at a moderate pace. 12 of the 16 officials on the Federal Open Market Committee predicted another rate increase this year, the same number as in the Fed's last round of forecasts in June. In its post-meeting statement, the Fed pointed to the strength of job growth and increases in household and business spending. The official optimism went only so far, however. Growth remains weak by historical standards, and the Fed indicated it sees no evidence of acceleration. Fed officials once again reduced their expectations for rate increases in coming years. The median prediction Wednesday was that the benchmark rate will stabilize at 2.8%, down from a median estimate of 3% in June. The Fed's benchmark rate now sits in a range between 1% and 1.25%. A level most Fed officials regard as providing modest encouragement for borrowing. Expectations of a third rate increase this year strengthened after the Fed's announcement, rising from a 57% chance to a 71% chance, according to CME Group. The Fed's next meeting is scheduled for October 31 and November 1, but the Fed is unlikely to raise rates any sooner than its final meeting of the year, in mid-December. Some economic indicators suggest that higher rates are warranted. The unemployment rate, at 4.4% in August, is below the level most officials regard as sustainable. Moreover, Fed officials predicted that the rate would fall to 4.1% next year. But other economic measures paint a contrasting picture. Job growth remains strong, suggesting that the workforce is still expanding. Wage growth is modest, suggesting employers are still able to find workers with relative ease, and inflation weakened in recent months, puzzling Fed officials and economists who had predicted that prices would begin to rise more quickly as labor market conditions tightened.